So I made a mistake on this trade. I was not concentrating. I should not have put the trade in the first place. So let me explain what happened here. Where did I buy the stock? Why do I say that I have made a mistake here? This is very important. Please concentrate. Please learn from my mistakes so that you don't make any of your own mistakes. Okay. So I bought the stock on this day, which is 24th of July. So let me put this tool here. So this is what I saw before I put the order. And I put a 2.5% position size. So the first reason I bought the stock is because of the moving averages. See, the 50 days above the 150 day, the 150 days above the 200-day moving average. So these are simple moving averages. All three are going up. The price is above all of these three moving averages. And it's a strong stage two uptrending stock. Okay. So that is one reason I put the order. Second reason, you look at this base. Okay. So if I draw the base starts from here. The base starts from here. Yeah. So this is point 1, point 2. So let me draw the contractions for you. This is point 1. This is point 2. This is point 3. This is point 4. And this is point 5. So as you can see, there are 5 points in the base. 5 points means 2 contractions or 2 compressions in the base. One is this compression, one is this compression. This is a correction. And every subsequent correction is smaller than the previous correction. So I need minimum 4 points in the base, which I have here. I also need minimum 10 candles in the base. So this candle I skip because it is completing point 1. So I start counting from this candle 1, 2, 3, 4, 5, 6, 7, 8, sufficiently more than 10 candles here. Okay. So there are more than 4 points. There are more than 10 candles and the moving averages are in my favor. So these are the 3 reasons I bought the stock. So I placed the order at the high of this candle. Okay. So let me remove this. Okay. So the high of this candle is 269. So let us put that amount, put that line here, 269. So at the close of this candle, I put a buy order here, which is 269 rupees. Just a second. Yeah. The high of this candle is 269. So I put the order at 269, which is 2.5% of my position size there. And I expected the stock to open below the yellow line and close above the yellow line. That's the idea. That's how I wanted to get into the stock. I wanted to put 2.5% of my position in this stock as it was coming out of the base. 2.5 is not a very large position. So I said, okay, let me take this trade. Now, the reason why I call this a mistake is because, see, if you notice here, this candle, if you look here, okay, this percentage number, this candle is 3.68%. So this is already up 3.6%, and here it is 9.78. That means the stock is already up 13 to 14% in just 2 days. See, that is not contraction. What I want on the right side is contraction in price. The price should get, the range of the candles should get smaller and smaller as the base develops towards the right hand side. See, this is tight price action. Okay. That is not what I saw here. Number one. Number two, if a stock goes up 13-14% in just a couple of days, obviously it will take some rest, right? Obviously, it might consolidate for a week or two before starting its leg up. Okay. So probably I bought the stock too early. I should have given it more time to consolidate further here. And then I would have got into the stock. Maybe here I entered too early, or I should not have entered at all because there is no price contraction here. Usually what happens, usually what I would like to see is this. So if this is point 1, this is point 2, this is point 3, I want point 4 here, I want point 3 here, sorry, 4, 5, 6, 7, this is what I would like to see. Okay, 1, 2, 3, 4, 5, 6, 7, 8. And this is where ideally I would like to buy. Preferably this should be in the green zone. The green zone is the upper quarter of the base. The blue zone is the second quarter of the base. The red zone is just the lower half of the base. So I don't want much price action in the red zone. So here, if you see after point number 2, only 3-4 candles are there in the red zone. Majority of the price action came in the uh, blue zone or the green zone. Momentarily dropped here, but it recovered. So that's a good sign. I wanted to see that to happen. I wanted a lot of candles to close above this red zone, which I got here. But the mistake I made is uh, I should have looked at these two candles, and I said to myself that this is uh, a lot of price action in just a couple of days, because buying takes a lot of energy. For example, if I let's say I want to put $5,000 in a stock, so first I need to earn the $5,000 with my salary or with my business. Then I put that $5,000 in my bank account. From my bank account, it goes to my trading account. From trading account, I do my research, and then I put that money in a stock, right? So buying takes a lot of energy. But selling, how much energy does selling need? For selling, all you need to do is to press the sell button. That's it. Okay. So for selling, you don't need much energy. For buying, you need a lot of energy. So here, 13-14% rise in 2 days means a lot of energy has been spent already to push the stock up from here to here. Okay. So I did not see contraction. I did not see accumulation of potential energy in a tight area of the base. If potential energy is not getting accumulated in the tight area of the base, then I should not be taking the trade, or even if I take the trade, I should be taking a small position, which I did right here. I mean, 2.5% is not a big position, but I would say that that's a mistake. Okay. Only when I see tight price action should I get into the trade in the first place. Here, I was too early to buy the stock. Look what happened next. After this candle, okay, it went up. The opening price was below. Here it is showing an updated opening price, but the opening price was below the yellow line. It went up, closed above the yellow line, but this was a high volume, weak closing candle. High volume, weak closing means the closing of the candle is below the midpoint of the candle. So the midpoint is high plus low divided by 2. So you see here the closing of the candle is below the midpoint of that candle. So that is called high volume weak closing, which represents supply. So on this day, the institutions were not buying, they were selling. Now, another thing is, if you see this candle is 1.73% above the previous day close. So if institutions are selling, then why is the stock closing above the previous day close? So I am getting mixed signals here. So since I am getting mixed signal, I sell half on that day, book a very tiny profit here. Okay. So I sell half. My stop loss is at 248, which is 8% below the yellow line. So my stop loss is here. My stop loss is here. So I sell half on that day. Now my potential risk is not 8%. My potential risk is 4% because I have sold half the position. Okay. I decided that I will give the stock one more day to see what happens, because here the stock has closed above the previous day close. So I said, okay, let me give it one more day. Even though there is institutional selling, let's see what happens next. Next day, there was no institutional selling, there was retail selling, and the price came down. Okay. So I decided that I have given it good time. Normally, in 1 or 2 days, the stock should show some signs of bullishness. Okay. So that I did not see here. Although institutions were buying here, but the stock continued to come down. It is down 4.65% from the previous day close, even though only retail clients are selling. So that is why I said, okay, let me sell another half. Okay, so I sold another half. So now I am down to 25% of my original position size. So my position size in this stock is very tiny. Okay, That is why now my potential risk from here to here is only 2%. It is not 8%. Although my stop loss is 8%, but my potential risk is only 2% on that remaining 25% of the position. Here, I have booked a very tiny loss. Okay. So, not a big loss on this trade. It has not yet hit my stop loss. I still have 25% position here. I did not sell on these 2 days because there is not much, no sign of institutional selling. So I said, okay, I have a very small 25% position in the stock, 25% of original position size, which is 2.5%, which is negligible position size. So I said, okay, let me keep that position. If it recovers, I will get the benefit of that. Okay. That is why I decided to keep the stock here. So let's see what happens. I don't know. Tomorrow it might hit my stop loss and start to go up, or tomorrow it might just open gap up and start to go up. I have no idea what will happen next. All I know is on 25% of my position, I have a 2% risk potential. On another 25% of my position, I have booked roughly 4.65, sorry, 3 to 4% loss, which is not a big deal. And on 50% of the position, I've actually booked a profit. Okay, because it closed above the yellow line. So overall, if I have to see, there is not much loss on this trade as originally expected. 8%, no. My total loss on this trade, if it hits my stop loss, my total loss is going to be even less than 3 or 4% overall. So realizing a mistake helps us take precautionary measures, okay, or preventive measures. I continuously kept on reducing my position size so that I limit my risk. I don't want to book 8% loss on a trade where I've already identified that I have made a mistake in the first place. I should not have got into this stock. So this is a detailed discussion I wanted to make so that, you know, look, we have to look for tight price action on the right side. If a stock is going up 14% in a couple of days, I am not going to buy that stock. I will give it some more time. And if it really powers up from there, I will just let it go. Okay. That is what I learned from this trade, which I wanted to share with you. If you have any questions, let me know in the comments section. Thank you so much.